Hi, everybody, and welcome back to video number 2 in chapter 12. When we left off, we were looking at illustrating the indirect method, and this is a beautiful illustration that they've done here. They've given us our income statement here, income statement here, and a comparative balance sheet here for Genesis. And you can see they've computed the differences in the current assets and liabilities, but they've also included the long-term assets and long-term liabilities as well. So for the operating activities, we're going to be concerning ourselves with our current assets and liabilities. So let's look at how we would put that together. First of all, I'm going to go grab this $38,000 here, which is my net income, and I'm going to adjust that for cash. So what I do is I bring the net income here, okay? And the next thing I do, and I do it exactly the way they're showing it here, I pick up the non-cash expenses. And so I'm going to go back and look and see where those are. As I look down this income statement, I see depreciation expense. I know that's a non-cash asset, or expense, I should say, because when we generate that journal entry, we debit depreciation expense and credit accumulated depreciation. Neither one of those affect cash. And the same thing's true with losses and gains. The losses and gains are non-cash expenses as well, usually from the sale of a long-term asset. So now we've got, I don't see any other non-cash expenses. So what we do over here is, as the first step here, I bring over the depreciation expense and I add that because I've subtracted this depreciation expense here to get to this net income. Now I need to add that back because it was a non-cash expense. So that's what I've done here. And then losses, same kind of thing. I've subtracted that to get to net income, and I need to add that back. Again, we're going to do exactly the opposite. So we take that and add it right back. So now let's look at the changes in our current assets. Here, our cash went up, right? From 2020 to 2021, it went from 12,000 to 17,000. That increased by 5,000. Accounts receivable went up by 20,000. Inventory went up by 14,000, and prepaids went up by 2,000. What that means is that I've used cash to increase those current assets. So that's a subtraction on our statement of cash flows. And so as you see, we've subtracted those here, here, and here as increases in current assets. Now, if I look back at the current liabilities, here they are here. We had accounts payable, which decreased by 5,000. Interest payable decreased by 1,000, but our income taxes went up. You can see the numbers and how that was calculated. So it's just the opposite. If increases make a current asset cash go down, a decrease in current liabilities makes the cash go down as well. So what we do, same kind of thing, an increase in or a decrease in accounts payable, a decrease in interest payable, that's a decrease in cash to make that happen. But we had an increase in income taxes payable, or $10,000. And you can see that the net cash provided, that means we increased cash, was $20,000 in operating income. And this is just for the operating section of the statement of cash flows. We still have financing and investing activities to do, but this is the first section at 20,000. All right, so adjustments for the income statements not affecting cash. Expenses and losses with no cash outflows are added back to net income, just like depreciation and losses were. Revenues and gains with no cash inflows are subtracted from net income. And as you can see, that's exactly what we did. This little chart tells you exactly what we just did. If the balance in current assets increases, we subtract that. And if it decreases, we add that. The exact opposite for current liabilities. I think the easiest way to remember that is my Nordstrom example. When I go to Nordstrom and I pay money, my cash goes down, but my inventory goes up. So any increase in a current asset, which inventory is, that increases, that's going to decrease my cash, just like it's shown here. All right. So adjustments in current assets and current liabilities, decrease in current assets are added to net income, increase in current assets are subtracted from net income. Increases in current liabilities are added to net income and decreases are subtracted, just like we did in the example. Nice example. All right. Are common adjustments to net income when computing net cash provided or used that under operating activities by the indirect method, and it shows these here. Non-cash, I think it's repetitious. We just went through this, but it says the same thing that we just did. Okay, let's take a look at cash flows from investing and financing activities. These are, I think, fairly self-evident, but hopefully it takes a little bit more analytical work to do this. It's a three-step process to determine cash provided or used by investing activities. Here we're going to identify the changes in investing related accounts, determine the cash effects using the T accounts and reconstructed entries, and report the cash flow effects. Okay, our cash flows from investing activities are first step. So if we look at this, here's our planned assets. They go from 250,000, I should say they go from 210,000 to 250,000. That represents a $40,000 increase. But how did that happen? Okay, this 40,000 increase from planned assets and a $12,000 increase in accumulated depreciation from 48,000 to 60,000. So if we reconstruct this, our planned assets, we purchased some planned assets of $60,000 by issuing 60,000 in notes payable to the seller. And so what that meant is that we had to debit planned assets and credit notes payable for that journal entry. And then we reported that we sold planned assets costing $20,000, but it had $12,000 of accumulated depreciation for $12,000 in cash. That resulted in that $6,000 loss, which we've already reported in the operating section. So now what we're going to do is we're going to say, okay, what did that journal entry look like? We debited cash. We debited accumulated depreciation when we sold those assets, which had a balance sheet total of $20,000, which meant that we had a $6,000 loss, non-cash loss. But we had a $2,000 cash gain, or not cash gain, but cash receipts. Now the other thing is we had depreciation expense of $24,000. So we debited depreciation expense and credited accumulated depreciation here for $24,000. So a little bit of analytical work going on here shows what happened to those long-term assets. Here we had the 210,000. We purchased this plant asset for $60,000, but we sold $20,000 of it. And the accumulated depreciation, same kind of thing. We sold $12,000. We had additional accumulated depreciation at $24,000, which drove the balance up to $60,000. And we got some cash flows of $2,000 from the sale of those plant assets. The $60,000 purchase was paid with a note payable, and it's non-cash. We purchased that with a note. So it's a non-cash investing and financing activity. Okay, so that is going to represent the investing activities. And now we're going to look at financing activities with a similar three-step process. And we do the same thing. So in this case, our long-term liabilities went up by $26,000. And why did that occur? That occurred because we had an increase in notes payable from $64,000 to $90,000, that $26,000. And the $26,000, we're going to go look at the fact that our notes payable of $34,000, it was retired for $18,000 in cash, representing a $16,000 gain. This gain we've already accounted for in the operating income, but we have a nice little cash bump here of $18,000, and our notes payable were retired for $34,000. Now, the third step here, we're going to take a look at the cash paid for notes retired in the financing activities section. So here's our T account here for notes payable. We retired that notes payable. That's going to reduce that by $34,000, but we're going to issue $60,000 additional notes. So this $124,000 offset by that $34,000 gives us an ending balance of $90,000 and a nice little cash bump here of $18,000. So now, from financing activities, we find that stock, we show that there's an increase in common stock here from $80,000 to $95,000, $15,000 worth. We issued stock. And step two, we reported that 3,000 shares of common stock are issued at par for $5 per share. That's the $15,000. And then we received that stock in terms of cash. So the cash we received was $15,000. No surprise there. Okay, retained earnings. Retained earnings here, retained earnings goes up from 88,000 to 112,000. So what that means is that we have to explain that. It goes up from our beginning balance of 88,000. It increases for the 38,000 of net income, but decreases for the $14,000 of dividends that were paid here in step two. And that's where we get the 112,000. So we know that we had to pay some cash here. And so that's going to reduce cash by $14,000. And that represents a good place, I think, for us to stop this video. And when we come back, we'll take a look at proving our cash balances. Until then, bye for now.